Hey everybody, just wanted to get this video out to you. We've seen some technical damage the last couple of days. My name's Carl Eggers. Obviously you're at the site or you're signed up for our emails, and so we do video, audio, we do articles, all kinds of things. And recently we've been writing about preparing for a correction, and that it's not uncommon to have 10 to 15% drops in any given year. And what always makes it hard is, A, going through them, period. We want the markets to go up generally, and they do for the long term. But what makes it also hard is when those corrections happen as quickly as they do sometimes. And that's what we are experiencing right now. Now, what's interesting is when you look at this picture of the S&P 500, you'll notice that we've been on this pretty good trajectory all the way through 2017. And then as the tax cuts started to get priced in, I believe that's partly what it was, and the economy getting better, we kind of went on a different trajectory, and one that was unsustainable. Now, having said that, you're going to hear a lot of people over the next few days saying, I knew this was going to happen, and that's not the case. Nobody knew this was going to happen when it happened. If you would have told me this trajectory here would have continued, I would have said, no, that's not going to continue. But to predict that the market would fall this percentage in this many days, nobody could predict that. But if you look what's happening here, we're kind of getting back to this normal trajectory. And we don't know what's going to happen the next few days, but this volume spike is huge. We are oversold. We were oversold Friday, by the way, after a 666-point drop on the Dow. And then we get an 1,100-point drop on Monday. And we'll see what tomorrow brings, but we are oversold. Now, this is important. When you have these episodes, which we have not seen in a long time, and I've been saying for months, when we have a 5% pullback, it's going to feel like 10. When we have a 10, it's going to feel like 20, right? These are going to feel bigger than we think or feel because we just haven't experienced that. It's been so calm and nice, but markets don't do that. People don't make 1,000% without any disruptions like they did on Bitcoin. And the stock market doesn't go up 20% every year without any interruption. So this is where the rubber meets the road. This is where either you're buying into the fear, you're selling into the fear, you're doing nothing because you're long term, you're averaging in, whatever the case, things are moving now. Things are happening, and probably interest rates rising, which we will look at in just a minute. But let's take a look at, the S&P here. I mean, we were way overbought on the RSI, which is the relative strength index. We were way overbought on that. This has pulled back. Again, this trajectory that we were on started to become unsustainable, and we're seeing this. Now, as we get down here, here's what's going to be important. The next few days, we should see a market that investors come in and buy these things hand over fist. If we're in a raging bull market like we've been in, if that's going to continue, you should see almost the opposite of what we've seen. You should see a 3, 4, 5, 600 point up day. And if you go, that's crazy, we would never see that. Go back to 2011 when we had 4 days in a row after the debt downgrade, when we lost our AAA rating. We had 4 days in a row of 4% moves. Down 4%, up 4%. Down 4%, up 4%. 4 days in a row. So could we experience that? Yeah, we could. Now I'm talking about the Dow. This is the S&P. Actually, I'm showing you the spiders, which is the S&P ETF. But you can see the 50-day moving average was breached. But we could get a lot more volatility, but we are oversold. Now here's really your culprit for what I think is causing this. The Federal Reserve comes out. We have a better than expected jobs report. The Federal Reserve comes out and says, hey, the economy is heating up and interest rates may rise more than we think, and we may have to hike 4 times next year, or 2018. And so now what you're seeing is, excuse me, interest rates, this is 2.05. This is 2.8. So we have seen this rapid ascension of rates, which is a good thing sometimes, right? Depending on who you are you lending? Are you borrowing? The fear is that interest rates rise too far, too fast. The Fed's behind the curve. They're going to slow this whole thing down, and the good economy we're experiencing slows down. And so not only last week did we see bonds sell off, because remember, when interest rates go up, bonds go down, but we saw stocks go down. Now, on Monday, we saw stocks go down, and at some point, interest rates started to turn around. People bought bonds, right? So at the end of the day, they did buy bonds. But this, to me, is your culprit of why we're getting the sell-off. The economy may be too good. Now, how about this for a picture? What is this deal here? This is the volatility index. Unbelievable, huge spike. This is the level we're sitting at Monday evening. So you can see that we had been falling. So every time we had a spike, it would fall to a lower level, spike, lower level, spike. So pretty soon volatility was just extinct. It's back. So what does that mean? Well, when it's like this, number one, you're going to get a bounce. And you can trade the bounce. You can invest in the bounce. But we're going to get a bounce in stocks when this subsides a little bit. But it probably also tells us that volatility may be here for a little while. In other words, we're going to start getting bigger days. So you need to start getting used to 200-300 point days. Now, volatility isn't just one-sided. Volatility means it goes up and down. And so we are probably going to see that over the next few days and weeks. When you have this type of carnage, which we're only back to really where we were at the beginning of January. But when you have this type of quick, swift selling that makes the nightly news and the radio shows, you get some damage that extends for multiple days. It doesn't just go away quickly. Remember the flash crash of 2010, the flash crash 2.0 of 2015? It didn't end quickly. Now, this is the picture of the Dow Jones, and over on the right side, you're seeing a logarithmic scale. So basically, as it goes up, you see the percentage of gains is smaller, so that's why, or the numbers are smaller. 13 to 14,000 isn't as big a percentage as 7 to 8,000, right? So, but look what we're seeing here. I mean, you can see why this isn't sustainable. Now, that doesn't mean that, well, if it isn't sustainable, why were we investing during that time? Because look, people didn't think it was sustainable here, and look how much higher you still are, right? That was 20,000. We're still at 24,000 plus. So what happened was this, again, as I said earlier, the trajectory, just like on cryptocurrencies, the trajectory isn't sustainable when it starts doing this move. Now, it doesn't mean it has to go down. It could have moved sideways, but we're just right here right now, okay? Let me clear this off and show you where we are. We are just right here. So, what would be normal? Well, here's the breakout. Remember the breakout in 16? Could we work our way, lower down to, here's the a moving average here. Could we come down to 21,000? Maybe. Again, 14.5% is an average drawdown in the middle of the year. So we haven't fallen that much yet. And again, remember at 26,000, a 10% pullback is 2,600 points. So as I've been stating, when you're preparing for correction, you have to prepare mentally for that correction, which is never easy. I'm not saying it is, but you also have to prepare and think about what your long-term goals are. You should have a proper asset allocation. I mean, I can't tell you in the last month how many people have said, why do I own this income stuff that's pretty boring? When the market's doing what it's doing. It serves a purpose. Now, when the markets pull back, you have a choice. If you want to get more aggressive, you can use the dry powder to do so. So asset allocation is very, very important. But don't let people tell you they all knew it was coming. Look, a correction, I personally would rather see, as hard as it is, a correction that is bunched together as opposed to this death by 100 points, right? I'd rather see the Dow fall 1,100 points in a day than 100 points over 11 days. Because what it does is it does give you some intense fear. And that fear is really what creates buying opportunities. For you savvy investors that are listening, you've seen this before. When there's fear and people are selling, that's when you take advantage of it. And I think that's what we're going to see over the next few days. So we were buying on Monday. Do we know it's the bottom? No. But we were buying in one of our strategies, and we were buying for clients that had a little too much cash and all those different things, because that is what you do. If you're selling at these levels after it's oversold, you're probably going to get whipsawed at some point. So have a long-term plan and stick to it. So really, I'm not going to go through any sectors because everything got beat up. Everything's a better deal today than it was on a week ago. Okay, so tune in to the Eggers Report this weekend on the podcast. I just want to give you some technical things we're looking at. And keep in mind, when we have 4% sell-offs like we did today, on average you get about a 1% bounce, at least the last 32 times this has happened since 2000, which we've had 32. This was the 33rd time we've fallen more than 4% in a day. So it isn't that uncommon. And when it happens, it usually, I mean, look at this picture, guys, before we sign off. This picture, during this bull market, these are nasty sell-offs. This is a 20% sell-off right here, right? Sell-off, 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 sell-off. Pretty big sell-off, pretty big sell-off, pretty big sell-off. And another sell-off right here. We don't know how far down it's going to go, but we do know this is like a rubber band. It gets stretched. And bear markets, by the way, don't just peak one day, right? If this turned into a bear market, and let's be open about that and say, what if it did? And I don't think it is. But what if it did? You would see this thing come down. You would see a testing. This thing could be a multi-month top. It could even break out to new highs and come down. Markets don't just peak like that and head straight down and that's it. That's not how it typically goes. Anything can happen, but that's not how it typically goes. Now, bottoms do happen that way. Bottoms just violently reverse like they did in 2009, and then up we go. Have a good evening. We will see you next time on the Eggers Report or on our website, eggerscapital.com. Don't forget, here's all the places on the page to get our information. Thanks, guys.